Welcome back. Hope you're having a good morning. Amnish Aggarwal, Head of Research at Prabhudas Lilladher, joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, Vedanta, that's been actually the stock of 2024. Out of nowhere, the stock has doubled. It's given you a dividend of around 43 rupees 50 paise. And that drives home the fact, right? This market is not meant for the faint-hearted because you bet on Mr. Aggarwal and you've actually made big money this year. They've declared a dividend now of around 8 rupees 50 paise. What's your view on the stock?
You see, we don't have a formal view on this stock, but having said that, I think all the mining companies have done off late, and Vedanta has got, I think, strong cash flows, and that is why it is just, you can say, paying dividends, and the dividend flow has been quite strong. But I think incrementally from here on, it will all depend on how the global situation continues in the commodities.
Okay, all right. Cut that. Amnish, what about this entire air traffic? We're in the festive season. You know, hotel rates are moving up. Air traffic as well as moved up. GMR Airports has come out with their update for November, and that's looking good. It's mid-teens. And December, in all probability, could be even better. How do you play this theme? You know, clearly this festive season, the spends are moving up. What do you like? Airports, hotels, aviation?
You see, this entire space, when it comes to, say, particularly 3Q and 4Q, these are the peak seasons for whether it is, you can say, travel, marriages, hotel industry, airports. And the post-monsoon festival season is the best time. But having said that, if you look at the overall consumption space, I think discretionary consumption in general is a bit better than I would say, the day-to-day items. And there too, I think hotels, airports, aviation, all these segments are doing well. Now, it can't be attributed just to marriages or something of that sort. But I think overall, it also shows that the consumer spending continues to shift in favor of discretionaries. That is clearly one. And secondly, in all these companies, the gestation period is very long. Say, for example, in case of airports, every big city is having an airport. You can't have a second player. Similarly, in case of hotels, also gestation period sometimes goes for at least 3 to 4 years. So I think the cycle into which some of these industries are currently operating, I think that cycle may last for, you can say, some time more. Now, having said that, I think as far as the play is concerned, I think your Indigo, which is your Interglobe Aviation, is one stock which we like. Secondly, on the aviation, on the hotel side, I think some of the stocks, for example, Lemon Tree is there, Chalet is there. These are the two names which we cover. But having said that, when the industry does well, then all the frontline names, whether it is Indian hotels or others, I think they will also do well. And I think hotel industry, I think it is going to be a third year in running where they are doing well. I think a couple of more years might be in store where the growth rates will be good, but definitely as we go along, the pace of growth might slow down, maybe from next year.
Amnish, first coming on Zomato. That's on our radar because next week, Zomato gets added to the Sensex, effective 23rd of December, and it will be the first new age tech company to be a part of a frontline index. Now, as a part of this rejig, I think Nuvama is estimating that we will see inflows of more than $500 million. Now, this week, investors seem to be favoring Swiggy, at least off late, Swiggy over Zomato, considering the valuation discount. Where would you come in on Zomato versus Swiggy?
See, if you compare Zomato and Swiggy, definitely today Swiggy is where, say, Zomato was a couple of years back in terms of whether it is AOV, whether these are other, you can say, margins and other parameters. Now, Zomato is actually showing you today profitability, the balance sheet is strong, whereas the Swiggy is indicating that it might take, say, another 4 quarters for it to start turning positive at the EBITDA level. So in terms of numbers, there's a lot of gap between the two. But at the same time, in terms of the valuations of the market cap also, Zomato is, I think, close to double where the Swiggy is getting traded today. I think both the companies have been growing, but the bigger, you can say, but the food delivery business is something which is now more like a steady business, and it is not likely to show, you can say, high growth. In the current context of Zomato being added to the index, I think the people are looking for, you can say, more stable, established company with multiple streams already in place, with now district also coming in. Zomato is firmly in place. Swiggy is, I would say, today in a situation where you are getting it cheaper. Maybe if the things pan out the way the company is looking at, if it actually shows turnaround over the next 4 quarters, then there's a probability of some valuation catch up happening in Swiggy versus Zomato.
Amnish, thank you very much for joining in. We want